Alrighty, welcome. Oh yeah, let's start out with a 3, 2, 1. Welcome. All right, we have a special treat today. Let's just start out with the topic: credit. Yeah, this is a big one. We're going to tackle the big mountain of information, misinformation. We're going to clear all that up, and by the end of this episode, you're going to have the chance to improve your scores 50 points at least. Come on, that's a give me by all the valuable information you're going to walk away with today. And on another note, I want to say that I am joined by my fabulous co-host, spouse, significant other, amazing partner, Sarah Abrams.
Well, thank you. That's quite an introduction.
Yes, well deserved. It has been 4 episodes previously. You've not made an episode until now. I apologize, but
I've been mentioned, though.
yes, you have been mentioned.
I will give you the kudos and credit, and thank you for that.
So Sarah is our marketing director. She works with me. We have 2 beautiful children together. We share a nonprofit together. We do a lot together. And today was just felt right to have her join me, make sure that I was on point. She compliments me in areas that I kind of lacking. And
vice versa.
And vice versa. Thank you. So we're going to talk about credit. Let's kick it off. Okay. There's a lot that goes into credit, and please slow me down or stop me, Sarah, if I get a little too involved here.
All right.
Okay. Yeah. All right. Credit. Whether you're going to buy a home, purchase a vehicle, apply for no payments, 12 months interest free on a mattress, whatever the goal is, the information is all the same. There are 3 different credit bureaus, the credit gods that control us: Experian, TransUnion, and Equifax. With that being said, the system is not my favorite, and I will be open and honest about that. First and foremost, these credit companies are marketing companies, and I have issue with that. But whatever. What does that mean? I'll kind of cover that a little bit as we progress. I want to talk most relevantly about mortgages and how it impacts us. There is FICO scores, and FICO is Fair Isaac Company, and that comes down to the algorithms or scoring model that is used to determine the score provided to you. Different industries have different models, and FICO even has some variations, like Equifax calls it the Beacon 5.0 of FICO, and that's just basically what they're looking at, and how they weight different information is how they provide the scores. There, again, are 3 bureaus. For Experian, the credit scores range from 320 to 844. TransUnion ranges from 309 to 839. And Equifax ranges from 334 to 818, okay? It's good to understand the range. Where do you fall within that range? If you're in the 300s, you pretty much have a pulse, and you're probably alive. But it takes a lot to get as low as the 309, minimum. I mean, I've never seen that low.
So I've heard people say that, like, I don't have credit. So is that literally like a 0? There's nothing in existence, or they're in the 3s?
Yeah, and this is a great question, and there is something we'll kind of deviate, because I didn't even have this in my notes as I should have. There are some mentalities that it's best to have no credit, and with no credit, that means that there's not enough data for a score to even be provided for you. And yes, you can purchase a home with no credit. A few things about that is, when we look at credit is one of the key most indicators of how we look at risk for lending. Okay. And so credit is not something that's just overnight. You earn it. It takes months, if not years, to develop and what we say establish credit. And so the likelihood of you showing that you can pay an automobile or pay a mortgage really shows us that you're okay to qualify for another mortgage or for your first mortgage. And so there's different, types of credit, and it's almost more difficult to have no credit because you have to purely make sure that nothing gets reported. Because if one thing goes on your credit, even if it's a collection, there is the odds are that something's going to be reported and it's going to provide you a score. And what is provided to the credit, even if it's not in your favor, could give you a very negative score. So it's this tricky thing. And if you're going to purchase a home with no credit, we have to have alternative types of credit. And what is alternative types of credit is something that is typically not on your credit report, such as utilities, cell phone bills, things of that nature, car insurance. We now have to collect that information and provide a 12-month history that shows, that you can pay something on time.
Got it.
So the other dynamic to this is if we do no credit, you are limited to a conforming loan limit. And here in Ventura County, where purchase prices and the non-conforming limit goes up to almost $950,000, you would be limited of how much of a home that you can purchase. The second part to this, there is a fancy word called a loan level price adjustment, aka an add to the pricing for no credit. So the interest rate that you would receive is not the best of the best by having no credit.
I see.
So it's food for thought. I guess that's where you have to take, that I'm going to say it's almost a risk of, do you really push to have no credit scores at all and walk down that fine line, or do you establish credit? Somebody always told me it's best to have credit, obtain credit when you don't need it, meaning you're not desperate for a car loan or a credit card. It's just something to have in case you do need it. And when you do need it, it is available often in, those dire terms, your credit or the terms, maybe you've lost your job, you don't have the income to qualify, and that's why you need that. And so having the credit already established could be quite beneficial. Right. There are some financial planners and some very well-known ones, and that's kind of what they preach, is to try to purchase a home and maintain no credit. To me, I'm more realistic that as we walk through the journey of life, there are some things that are quite beneficial to finance, even if you can pay cash for it, and that's always the best. But hey, if you're gonna, purchase, a mattress or something even larger, windows for your house or carpet, and all of those that I just mentioned, I've personally taken advantage of 12 months, no interest. And if I'm not paying interest on it, I can do other things with my money to earn interest, and it is beneficial. Mm-hmm. And so again, understanding how credit works, it's better to have the best credit that you can to utilize it when you want it or need it.
Right.
Yeah. Well, thank you for starting us out strong, man. You had me working on that one. Okay. So with this and kind of the scores that we're talking about, there are other templates, there's the FICO 08, there's the Vantage, there's different models and methods for scoring. And again, what we look at in the mortgage world is the FICO. And where do we typically need? It varies, what's the minimum credit score, but most programs are somewhere around the 620 to get into conventional FHA. Of course, there's always exceptions to go lower, down to 550, 580, et cetera. But again, how do we get your credit? And after this conversation, hopefully we can get you in the 700, 740, 780. And it takes years to get up to the 800. So let's just kind of walk through the range. What is poor credit? Somewhere, again, where the credit bureau started in the 300s up to, I'm going to say 579 is poor credit. I mean, you have negative things being reported, you have lates, you have multiples of all of that. You haven't done so well in your credit history, okay? 580 to a 669 is going to be fair. You have some established credit. You definitely have some derogatory, whether it's late payments, collections, a combination of that. Then we get into what's good. Good is, 670 to about 739. Once you crest over the 700 score, really that's a tipping point. And for mortgages specifically, there's pricing incentives at 660, 680, 700, 720, 740. These 20 increments, 20-point increments is where you're going to gradually see some improvement. Above a 760, you're pretty much the cream of the crop. You're, 800 or 790 is not going to get you any better pricing than a 760 for the most part. Once you're above 740 to, that's very good. And I'm just going to throw 800 plus is exceptional. It's very rare that I see an 800 plus. It's also very rare on somebody that's probably, younger than 35, 40 years old. It takes a tremendous amount, what goes into credit. It's your payment history. It's the amount that you owe. It's the type of credit. Is it an installment? Is it a revolving, like a credit card? Is it a mortgage? It takes having revolving accounts for years, 10 years. And that's not something easily, you just can't achieve that if the minimum credit age is 18 years old, right. That it takes years to establish that. So, anybody with 800 credit scores, it's well-deserved. Kudos to you. And you're doing a great job. Keep it up. So, you following with me here, Sarah, so far?
Yeah.
Okay. So we've kind of chatted about the different models. We talked about different credit scores. Let's get a little bit more in depth into, again, what comprises the credit scores themselves. So specifically the algorithm, the model that we're talking is the FICO. 35%, so the largest percentage of how that score is derived is from payment history, okay? If your payment's due on the first of the month, most accounts, especially mortgages, have grace periods. And then they get into after you're beyond the grace period, but now 30 days late. That's one type of delinquency. Then it goes 60 days late. That's the next level. Then you have 90 days delinquency. And, when you start to get to that point, this is where the scores will drastically drop. It's something occasionally you can still have 700 plus scores with a 30-day late. With that, it takes nothing but time for your scores to improve. There's no immediate thing that you can do other than continuing to pay your bills on time. And this also goes into if you're a creditor, you're a lender, you want to see a good payment history, right? It's somebody that understands that when the bills are due, they're able to pay those, they're able to work through their monthly budget and cash flow. And so the payment history is significant.
You said something. So it takes time to build the positive credit, but one derogatory can set you back.
Yes.
Faster than several positives. So it takes longer to rebuild that credit that you've negatively impacted than it takes to you've undone yourself.
Yeah, absolutely. And let's just, let's give an example. Somebody has a great payment history. They've got low to moderate liabilities. You're probably a 740 to 760. And let's just say you have a 30-day late. you were on vacation, you had something happen, it was a complete oversight. And that happens. How devastating is that? Your score would probably drop anywhere from 40 to 60 points.
That much?
Just by a 30-day late. Yes.
Wow.
And then again, it's each month, the points may go up 3 to 5 points each month. They look at how delinquent was it. So was it a 30, 60, 90 plus? And then how long ago was it? They track the date, the month and year of when that derogatory was. And so, overall, your credit history is not forever, but it's a good 7 to 10 years. And it takes a minimum of 7 years, sometimes longer, for those items to start falling off. If you've had a foreclosure or bankruptcy, it's not the end of the world. It's just the end of credit for
this moment of life.
Exactly, for a set time period. And there is, after bankruptcy, it's not uncommon for us to see clients with 700 credit scores, right? You can reestablish yourself, and in pretty timely manner, you can do that. But obviously the payment history really plays into that.
Yeah.
Now, the next largest amount is amount owed. And so this is 30%. This is the next highest. This is the one that we can really play with. This is the game changer of how do we get your credit scores up 50 points. And the one that you have the most control over is amount owed. Now, let's talk about the different types of credit. So a mortgage is the best, right? Because it's fixed in time, often a very long time period. You do a 30-year mortgage. Most of the time, the payments are truly a 30-year fixed. And so you have a stable monthly payment over a very, very long tenure. And so that's going to be, a mortgage is the best type, especially if you're applying for other mortgages. We want to see that mortgage history because it's the most comparable to what we're doing. And likewise, if you don't have a mortgage, then oftentimes we want to look at your rental history because that's most comparable to the mortgage. The next is an installment loan. I mean, we can say that a mortgage is an installment loan. It is. It's just secured by a property. An installment loan is going to be a car loan, a boat loan, an RV loan, something, again, that's finite in term, that has set payments. You work the balance from greatest, and it amortizes down to zero over a set time period. The one that makes the most impact is revolving credit. This is credit cards. And this is where some people can get into a lot of trouble. And this is where it will sting you. But at the same time, understanding how the revolving and the limits of revolving work, you can also boost your scores from 660 to 740. It's actually quite easy to move your credit score, move the needle, as they say, the lower your scores are, right? Because there's certain things, and a lot of times it's maxing out your credit cards without understanding that you're maxing out your credit cards. So let's get into this rule of 25. And this is kind of my own thing. Where do I gather my information as I do a lot of reading? One, from the credit bureaus directly. Two, I've been working with credit for 23 years. And so I see firsthand how these changes, and this is also the joy of my profession, is, no two loans are the same. No two credit reports are the same, right? You might have a 740 score and a 740 score, but what's on there, how it's reported, the information is quite different. With revolving accounts, they heavily look at the balance or the utilization divided by the available credit. And I'll give some examples here. So you've got, a limit of $1,000 and you have $500 charged, $500 balance divided by the credit limit of 1,000, that's a 50% utilization. In that simple example, that balance is hindering your credit scores. It is dropping your scores.
Yeah, and I don't think, I didn't know that for the longest time. And I think a lot of people I've only used half of my credit limit.
Yeah.
I'm doing great, right? I haven't maxed out my credit cards. Well, which is good. I mean, don't max out your credit cards, but if it's hindering your scores, people don't know that.
Right, right. Well, and then they're, without really, I mean, let's keep it real. Nobody has ever sat anybody down and said, "Hey, let's go over credit and talk about this," other than your awesome mortgage guy, right? But in high school, we can't wait to get out of high school, and you can't wait to be 18 and apply for your first credit card, and you're like, "Hey, they gave me $1,000 limit. It means I can use up to $1,000." And yes, that is absolutely correct. But the amount of utilization goes with risk. And this is the key word I always say, whether it's referencing credit, whether it's referencing, a pre-approval, anything that can impact risk is going to be something that is negative, whether in your credit score or the interest rate that's provided to you. Risk is the biggest thing. We want to make sure that we're paid back. And how do we know that? Is the patterns, it's the algorithms that they use to determine, okay, somebody that has 4 credit cards that's maxed them all out.
Right.
One, that's negatively impacting their credit score for a reason. And 2, that's the pattern of spending that they use. They're a higher liability for a mortgage.
Sure.
Right? So it's all cause and effect. So this rule of 25, and the credit bureaus state that they actually look at and prefer to have balances of 33% or below. I still find that 33%, they will still mark you down points for having that type of balance. And so I always kind of, preach that keep it at 25% or below. One, that's a good conservative approach and staying within your budget, your spending means. But then 2, also using credit cards and maximizing your potential of points within your scores.
Right.
So we get into, with this rule of 25, some people think, oh, let me just, close a credit card and I can, I don't use that credit card anymore. And actually that could be the worst thing that you could do, because by closing a credit card, you're also closing available credit. And so these formulas, yes, they look at individual credit cards that, hey, you have $900 charged on $1,000 available credit, but it's also cumulative. So if you have 4 credit cards with $1,000 potential balance credit limit on all 4, $4,000 total limit, and you have $2,500 charged, your ratio is going to be better than if you had $3,000 charged, which is 75%. And so when you go to close an account, by removing that available credit, that also increases the percentage of utilization and thus decreases your credit scores.
Right.
So what I really say in credit is anything that you are going to do it slowly. Don't open up a whole bunch of credit cards at the same time. Don't close a whole bunch of credit cards at the same time. Use, it's best practice to have a couple different credit cards and maintain those forever. I see a lot of people get into credit trouble when they're applying, everywhere that they go. Kohl's to save 10%. I mean, let's keep it real. I mean, there are times that you probably need to charge, but do you need to charge $50 in pants? I mean, credit's one of those tricky things. It's nice to have it, but it's something that truly they don't want you to overutilize it in every aspect of that. So the amount that is owed, this is the game changer. And I'm really going to reinforce that of improving your credit scores. Take a look at your revolving accounts. What can you pay down? How much can you pay down? Because you will see your credit scores increase just by paying down credit cards, okay? Next, we go into in-use and new credit, and this is 20% of your credit scores. 10% of that is the new credit. 10% of that is the types of credit used. And so I've already explained, the types of credit from a mortgage to a revolving. But the new credit, and this is again what I just said, is not too much new credit at the same time. Don't go to Kohl's and then go to Macy's and then go apply for a mortgage. It looks like you're living off of your credit, and that can have an impact on your scores. And then the final 15% is length of credit. This is the most difficult one to improve. It's only time. And so again, as I'm saying, it takes 7 to 10 years for things to fall off. Your credit, like if you're rebuilding or just starting, if you go and open up a credit card and you only have, you're 18 years old and you only have one credit card, when you have limited credit, that is where it is you will see the pendulum swing even more so when you have such limited credit of what those balances are. And so it's just time. Make sure and be patient and, keep your payment. It's always good to have an auto pay set up so it's guaranteed that it's going to pay on time. But if you can pay extra and pay early and pay manually, keep those balances down to maintain good credit scores. Again, it's one of those, especially when you come to apply for a mortgage and we're talking about the interest rates, I want to get you the best rate that you can, but I also have to work with the credit that you've either done a very great job of working at, or you've completely just disregarded it, and that's going to also play into the rates and qualification that we do.
Sure.
So
yeah, I don't think I got my first credit card till I was almost 30. And a lot of it was it was kind of, in our house, it was credit cards are bad.
yeah,
That's how it was kind of always beat into my head of credit cards are bad. Don't use credit cards. Don't use credit cards. So I didn't. And then it finally came time in life where it was wait a minute, what am I doing? So I lost 10 years
right
of time that I could have been building credit.
And that's exactly it. Now that you learn that, and that's the difficulty of, you can't go back and just flip a switch and take those 10 years back. It's just understanding how credit works and slowly doing it and doing it right. So
Sure.
Good thing you're married to a credit guru that works with credit. And, I am fortunate because of my profession to see credit and understand credit, to have this information and these lessons that I've learned throughout the years. So let's keep moving. I'm going to bring up some just different topics about credit. And we're going to spell some disbeliefs and talk the truth. Inquiries. What are inquiries, Sarah? Do you know what an inquiry is?
When someone, like a lender, pulls your credit because you're applying for credit in some aspect.
Absolutely, that's correct. Do you know the difference between a soft and a hard inquiry?
Not well enough to explain it eloquently here.
Okay. Well, I mean, you pretty much said it correct with an inquiry is you are applying for credit. Inquiries are something that are measured and kept track of. Again, with the credit bureaus, they want to look at how fast and how frequent you are out applying for credit. Credit is something that you buy now and you pay later. So you're financing something, and needs to be a calculated risk of how this is determined. A hard inquiry is exactly what you said. You've applied for it. You are making an inquiry. This will show up on your credit. On our credit reports, we track immediately. We see up to 4 months. However, the credit bureaus look up to 2 years. So, they are keeping track of these inquiries to see, again, how frequently you're applying for types of credit. Now, a soft inquiry is something where us as lenders, especially, we do have this option where we can just take a little snapshot and preview your credit without actually doing a hard inquiry. Now, where does this come into play? How is this possible? Sure. You've applied with me for a mortgage and we got you pre-approved, and that credit report is good for 120 days. So, 2 months in, you've gotten yourself into a purchase contract, and now we're sending your loan file up to the underwriter to review it and approve it prior to the clear to close. So when we're all done and going to issue the final loan documents and clear to close, the underwriter will do a soft credit. And what they're looking for is not necessarily credit scores. This is just looking at trade lines. Has anything changed? Okay. Did you go and now we see an inquiry from Ventura Toyota? And Sarah, did you go out and buy a new car while we were shopping for mortgages?
Go to Home Depot, start purchasing your new furniture for the house or something.
Exactly. The second part of this is, let's say you had a Chase credit card and the balance was zero, and now at our clear to close, the balance is $10,000 and you have a $250 minimum payment. Something drastic has changed. That's not just you went out over the weekend and you bought dinner. You bought something significant enough that for us as lenders, we need to take that into qualification consideration. So utilizing the soft credit is powerful for us as lenders to just checks and balances. We can also do this in the beginning, and I'm going to get into what trigger leads are here in a little bit. But it is something, as we pre-qualify and pre-approve you, we can also do a soft inquiry from the beginning. I'm going to get more detailed into that here in a few minutes. Okay. Collections. Oh boy, this is one that we see. We see it all the time. It's not the end of the world, but it does impact you. Collections are negative, right? You haven't paid somebody. They sent you to the collection farm. Sometimes... and frequently, actually, you didn't pay your cell phone to Verizon, and not only is Verizon upset with you and sends you to collection, but they also, at some point, if they cannot recover it through their retention department, then they'll even sell that, and they sell it to XYZ collection company. If you owed Verizon $500, they'll take $100 from this XYZ. And then basically they're trying to recover some of their losses.
Right.
And so it's not uncommon that, it's different third parties that you see these collections from. Now, when something's gone to collection, and, you're a perfect example. I'm saying this with all the love in the world. When I met you, you didn't have the perfect credit because, again, you didn't understand. Nobody ever taught you. You didn't have credit cards. But there was one or two collections, and that really hurt your credit scores. And I want to say, from memory, it was 550 credit scores that you had.
Right.
And so this is a good example of okay, no positive credit and a couple collections. Yeah, you can still have credit scores, and you will have credit scores, but it's going to be in the 550 range. It's probably not going to be high enough to apply or be granted much of credit of anything. Now, here's the thing about collections, and this is something I see frequently is again, it's a Verizon bill. You closed an account and there was a small balance of $30 left. And the instinct is to just instantly pay that $30 off. When it goes to collection status, it does not read the balance, meaning that collection could be $10,000, it could be $10, and it's still going to provide you the same credit scores. Okay. So collections, once they hit collection status, they are more concerned with the date of the collection. So if you had a collection that was 5 years ago and it was $500, my recommendation when you come to me is do not pay that collection. If you pay that collection, it's like you're waking a sleeping giant. It now will say zero, which is irrelevant of how it reads on your credit report, but it now has date of activity, not 5 years ago, it now updates to today. And so because of that, the collection with a fresh date will bring your scores down. So if you think you're doing the right thing by paying off an old collection, it could actually bite you.
No, just to clarify, you're suggesting that people don't address these credit issues or collections issues prior to going and trying to get lending from you.
Correct.
You're not talking about in general, but I need to refer to my lender. I need to refer to who I'm going to pull the credit before I start trying to pay off X, Y, and Z.
One, if you've never been given professional advice on credit from A to Z of how credit works, including a talk like this, do not try to fix your own credit. You don't know what you're doing. And that may sound harsh, it may sound blunt, but it's the reality. I also get a lot of people that are, they'll come to me and they say, hey, I would like to get pre-approved. I'd love to purchase a home. It's, it's a dream of ours and we're really excited. I'm just not ready yet. I need to take 6 months and pay a few things off. And they're reluctant for me to pull their credit.
Right.
And I flip this on them and I said, why are we going to let 6 months go to waste where if there's something that I can help you with, including increase and improve your scenario and provide you better terms down the road, why would we not want to do that today and start a game plan? And so whether it's myself as a lender, there's many excellent lenders out there, we work with credit all day long. If there's something beyond my capacity, I also have credit repair companies that are known and trusted that I can further review you to. And this is one, especially like, let's just say this, give an example of you're going to formally apply in 6 months, you want to take some time to improve some things, and you have this collection that's 5 years old. There's not much that I can do other than advise you do not pay that. Now, I have credit repair companies, and what they can actually do is for something to be posted onto your credit, there is 20 to 30 different steps that it has to go through, from notification, documentation, etc. They, I can't just report something on your credit. There's proper steps, rightfully so. Well, when you're a $500 collection, yes, it's on your credit, but maybe they skipped a few of those steps. And so being forthcoming, what these credit repair companies do is they're searching the loopholes. They're searching for where did this company make missteps that we can force them to remove that collection. And so what they do is, never any company that you're working with, don't pay thousands of dollars up front. All of the companies that I work, they charge a monthly fee that's less than $100. And most of the time between 6 months, and if your credit's really damaged, a year, they can make significant results. And what they do is we start out with an initial credit report. I can provide, if I've pulled your credit, I'll provide my report free of charge. What we do is they start from the very beginning, they start writing letters. And each month they go, hey, Mr. Collection, I'd like to see your documentation. And then they'll provide it. Then the next month, you know what, that was good, but we also need to see this documentation and where this was filed. Maybe they'll provide it. Maybe they won't. They're going to get to a crossroads where more likely than not, that has not been provided. And now that collection has to be removed from your credit. So that collection being removed from your credit, that's a game changer. This is where your points can significantly go up.
Because it's been formally removed, not just paid by you.
Correct. It is no longer visible on the report. And this is, in the early phase when I'm working with a client and I see a collection that's 5 years old, I'll say, call them. You have nothing to lose. Call them and settle with them, but only settle if they are willing to give it to you in writing. Hey, I had a $500 collection. I'll pay you $300, but you're going to not update my collection. You're going to remove it from my credit report. You put that in writing and I'll pay you.
Right.
And we also see some success with that as well. So collections are a big one. And that's something, again, you can purchase a home with collections. There are thresholds depending upon the type of loan. FHA has limits of how many collections on a total dollar amount basis that you can have. But it's also something that if we have time, we can also work to get those collections removed. And so don't be scared about collections, but it is something, if you just put them in the dark corner, they're going to continue to haunt you for quite a while.
Yeah. And I mean, it's fun to see you, as you've worked with several different clients that I'm aware of and hear conversations and whatnot of they've come in, they're kind of like, oh, I'm not ready yet. And you've had this conversation. Well, let's formally create this plan.
Yeah.
Don't just go off on your own and think
Yeah.
of what you're going to do, because you might be doing the right things. You might be doing the wrong things. And 6 months, 12 months later, after they have worked your plan,
Yeah.
they come back, their credit has significantly improved. They're in a better place to purchase a home, and they purchase a home. And so just outsider in, I'm not a part of those conversations and those plans, but I've seen it, I've witnessed some of these great stories of working a plan with a professional, not
Yep.
going on it on your own.
Yeah, no, I agree. And it is very touching on my end as well to see that and see those, not because they listen to me, but because they listen to me, it actually works and it is improving their circumstances, and then they're buying a home. And so, yeah, let's keep moving. So collections is a big one. Charge-offs. Do you know what a charge-off is?
I had no idea.
Charge-off. You went and got a car loan and maybe you didn't finish paying that car loan.
Okay.
And so the bank, for whatever reason, instead of trying to collect on it, they've just charged it off. A lot of times they send you a 1099 for you're going to be taxed on that amount. And they're also using it as a write-off of, hey, we took a loss of $5,000. So that's considered a charge off. And sadly, but also on the bright side, I don't know how I feel about that. Charge-offs are kind of seen better than collections. I mean, so
It's also better than the repo man, right?
yeah, exactly. Yeah, for sure. Okay, disputed trade lines. I see this all the time. And when there's a dispute on a trade line, so a trade line is an individual account. So you have 3 credit cards, Chase, Wachovia, Capital One. Each account we consider or call that a trade line, okay? Disputed trade lines, when you dispute something, there are some good laws in place to help you. And so what they do is, if you've disputed an account, maybe some charges, when you go to pull your credit, the credit report and the score does not take that disputed account into consideration. Okay? So so basically, if somebody fraudulently charged $5,000 and you've got that on your credit card and you're working with your credit card company with the dispute, and then now all of a sudden timing strikes, you're buying a new home, they don't want that to negatively impact what you're trying to do.
Sure.
However, this is also a form of manipulation. Back in the early days, before lenders caught on to this trick, we found that somebody would have lots of credit cards, lots of accounts, and they would go dispute everything to increase their credit scores, right?
Interesting, yeah.
So it can manipulate that. And so if you have disputed trade lines, if the balance is 0, then we don't need to do anything. But let's say you have a balance on a trade line, we actually have to have you remove the dispute, and I have to re-pull your credit.
Oh.
It's a big deal, just over disputes, because it can alter your scores.
Okay.
Kind of, manipulatively,
Right.
it could alter your scores. And so, for anybody disputing accounts, even if it's old and that was a couple years ago, make sure that if you ever dispute something, that you follow up to make sure to properly remove the dispute, because we don't want to have to re-pull your credit. I'm always nervous, especially mid-transaction, that we have to re-pull your credit.
Yeah.
Something could pop up that even you weren't aware of, and that could be a game changer in qualifying, not qualifying, or even the interest rate that's offered.
Huh. All right.
Yep. Opening accounts, I kind of chatted about this. We don't want to open too many accounts at once. When you're going to purchase a home, this is what I do, right? So let's talk mortgages. It is okay to have multiple inquiries for the same trade. So as a mortgage lender, you apply with American Pacific Mortgage, you go to Quicken, as long as you do that within a specified time period, you're not penalized for the same industry for shopping around. We encourage that. And so, what's the time period? It varies by credit bureau, somewhere between 14 and 30 days. So you want to do your shopping pretty diligently,
Right.
Get a loan estimate with the fees and the interest rate, everything, all the terms that are offered to you, and don't be scared to call somebody else up and, see what they can do. And I always say it's not always just the rate, it's also the service and the fees, everything correlates.
Right.
But we want to make sure that you understand that time period, that it is okay and it's not going to hinder your scores for another hard inquiry. Now, you've applied for a mortgage with American Pacific and you went to Kohl's and your wife wanted to save 10%. So she applied for a new card there. And then you got a bonus at work and you're excited and you're going to go to Ventura Toyota and go buy a new truck. Now we've got some issues, right?
Different lines.
Different trade lines, different types of credit that you're looking to extend in a short time period. A couple things here. One, it will ding you on the credit score, not significantly, but your points will be, 8 to 10 points probably lower in that example. But also for us, if we see that you have an inquiry from Toyota, you need to write us a letter confirming, yes, I did purchase a new Toyota, and provide the statement of anything that was financed. Or two, provide us a letter validating that you did not, you only inquired, you never made a purchase. And that could be mortgage fraud if not properly disclosed. So we do track the inquiries. It's something that's, again, very important to us because it could impact or affect your qualification of a loan.
Now, I know we've had clients call before, just kind of calling around. Can you use a credit report from another lender to satisfy your pre-approval and your loan with them?
Yeah, great question. So twofold. One, on a pre-qualification. If you just want to go over the phone and run through some numbers of, here's roughly how much I make and, I'm looking at this amount of purchase price with this amount down. Here's a copy of my credit report. Yeah, I can run all the numbers and say, based upon what you've provided, that would be you would potentially pre-qualify for that amount. It's not any of my hard data. It's not me making my own credit report. It's just it's saying what if and potentially yes. That's what a pre-qualification is. The pre-approval is us doing our diligence. A lot of the credit reports, and there's a lot of different companies that issue what's called a tri-merge report, all three bureaus consolidated into one report. Those are proprietary. And so I cannot reissue a credit report from someone else, unfortunately. We have to have our own application. We have to have our own hard inquiry from you to do the formal pre-approval. But that's also the power of the pre-approval, stating that, yes, we can grant you a loan. Yes, you are pre-approved to purchase.
Yeah.
So hopefully that answers your question.
Absolutely.
Yeah. Okay. Closing accounts. Again, I spoke to this. Don't close accounts too fast, too many together. If you're never going to use an account again, close it. I mean, at one point in time, I had a K Jewelers account for somebody here in this room. And I don't ever plan on getting married again. And
good.
I don't finance too much jewelry. I don't need to finance too much jewelry. So it's one of those things that K Jewelers, I closed that account and I'm okay with that. I also made sure that I wasn't purchasing anything at that time or going to have any anticipated credit pulls around that time. And so closed that account and life is good, moved on. I don't feel any impact from closing that account. Okay. Contingent liabilities. Any guesses?
I hear you say that phrase all the time, and I'm on the spot, and I couldn't tell you.
All right. Well, contingent liability. This is you've maybe purchased a vehicle, but it's not for you. It's for a significant other, but they pay it.
Right.
And they always want to tell me how fast, but they pay it. Well, if you are co-signing for someone else, you are obligated under that note. There are very few and very specific rules for us to not account for that liability. And so when you are able to exclude it, it is considered a contingent liability. So whether you're married, not married, if somebody else pays this liability, let's take family member, your sister. Doesn't matter which one, we don't need to name a sister, but let's just say your sister comes to you and says, hey, will you co-sign for me for this car loan? And you decide, yes, you will. We must have 12 consecutive payments that your sister has made that loan payment and on time with an account that you are not linked to. So it can't be a joint checking account that your name is on it, that you have access to it. It has to be their own funds that we can truly document their payments, whether it's through canceled checks or ACH deposits. Then we get bank statements. And let's even say this account is only 3 months old. It's a brand new account. I cannot exclude that. It has to be 12 consecutive, most recent months that we can document that another party pays it, and then we will allow that account to be excluded from your qualifying.
Right.
So it's, if you're listening to me, it's very, very specific of what we need. And the moral of the story, don't co-sign. If you have to, I understand there's certain situations, but if possible, actually, you may have heard I was on the phone last week. I had somebody that had called me up. He is pre-approved right now with me. And he says, hey, I wanted to call and ask, my significant other, my girlfriend, she's asked me to get a car loan in my name because I have better credit and I can get a better interest rate and a lower payment.
Right.
And I said, sir, you can, but I want you to understand how this will impact you. It will impact you because your income is already tight for what you're wanting to pre-approve for. So we would have to reduce how much you're pre-approved for. But furthermore, I want you to kind of think about what you're doing. They had their credit, which they had negative marks on, and now they want to come take a free ride on your good credit. Who's to say that's not going to happen again? And now your credit is at the mercy of somebody else. And once he understood that, he was like, nope, I got it. I'll talk to her. Thanks for letting me know. And we moved right on. So think about co-signing. I understand there's a time and place for that. And I'm not saying never do it. Just think it through of how it will impact you.
Well, and be strategic too. Like if you are going to do it, think about the 12 months.
Yeah, absolutely. Like, are you going to make any foreseeable purchases within the 12 months? This also kind of coincides with business liabilities. Commonly see, self-employed borrower, they have a vehicle that the business pays for. It's very much like a contingent liability. Not only do we need to see the canceled checks, but we also need to see it on the tax returns that the business has that as an asset and also reflects the liability in there. We want to make sure that the business is truly claiming what they say that they're claiming.
Completely separate from you.
Yeah. And then we can exclude that. A side note, a lot of business or commercial liabilities do not reflect in personal credit reports. You and I have a commercial loan that does not pull up on our credit report.
Business credit cards.
Business credit cards do not pull up a lot of times in your personal credit report. So those are those wink, wink, good little things to know and note. If you're self-employed, use the business credit card. So, yeah. Okay, another topic that I'm going to bring up, and I see this frequently, I call him the points chaser, right? So typically, historically, these are well-qualified borrowers that do understand credit, and they want to exclusively use their credit card each month, and then they pay it off in full each month. And their objective is to either obtain points, some type of frequent flyer miles or points through whatever business. And then also on large purchases, there's also added protection with purchasing with Visa, MasterCard, whatever, etc. I'm kind of a mixed on this. One, for the right borrower, they do understand that. And so I think it is wise. I think, just speaking with the office here, we've purchased, I don't know how many large items with the new office. TVs, I spent $6,000. Yeah, I put that on the credit card, but I immediately paid it. But I wanted the protection of having that under the credit card while it was being ordered. And, in case there was any fraud or any, delivery damage, whatever the reason, then I could test that and be protected. Now, here's where you run into different issues. And this is why I'm mixed about it, is when you go to pull your credit, the credit information is always delayed. So what do I mean by that is, okay, last month you charged $6,000. The statement gets issued. You write the check for $6,000. You owed $0 for a short time period. And then now you're in your new cycle. You're charging up, and we're 15 days into it, you've charged $3,000 of items. Well, the credit report is again delayed, and it will post at random cycle dates that we're truly unaware of the balance of your last statement. And that balance was $6,000.
Right.
Okay. Well, who's to say that you're not necessarily keeping track of your credit utilization of your credit card? And although you do pay it each month, if your credit limit is $10,000 and you use $6,000 to buy these TVs, you're at 60% utilization, even though you paid it in full. When I pull your credit, it's a snapshot of that moment in time with those balances. And that utilization of 60% will negatively impact you, and it will bring down your credit scores. So I understand the concept. I understand the mentality. I've always had very efficient clients that do truly what they say, and that's paid off every month. I'm just, as devil's advocate, saying there may be times that you pull your credit and your scores aren't as high as they could be with that method of paying.
Right.
Okay. So just wanted to point that out, and just as food for thought, again, you could get the protection of it, but then you can pay that card, before the statement's due. I think it's always, again, just being aware of when you're going to be applying for different credit and when you're actually going to pull your credit. Make sure 2 to 3 months ahead of time that, hey, if that's your method, but that you're going to be purchasing a home, stop that method, pay everything out of your regular checking account, and then give it a good 30 to 60 days prior to pulling your credit ahead of time.
Yeah, that makes sense.
Yeah. Okay. Increasing credit scores. So, this is something that we do frequently. I don't want to say every single loan, but, I even have a loan in process. They're purchasing a, $1.3 million home, and we had time. And I said, hey, can I help you get your scores up 20 points to get you a better rate? And they said, heck yeah. And so it was one of those that every single credit report that I have, there's a feature on there called Credit Expert. And whereas it shows us any potential improvements, and there's a threshold of what are potential and how much money you have. But we can also run scenarios. If you're at a 719 score and I need a 740, how do we get those 21 points? There's always some type of formula, and it gives us the probability. If you pay this account, and typically, again, that's what it is paying off some type of debt. If you follow our instructions to a T, and sometimes it's weird balances, instead of paying it in full, it might want an $8 balance. Whatever that is, If you follow the instructions, it will provide. And again, with this client that I'm referencing, we only needed a few points. She did have a 719 score. It's one that we were able to get the scores that we needed by her paying down a few $1,000s of debt. She gathered the documentation, provided that to me. I updated her credit. Boom, done, handled.
That goes back to the beginning of our conversation about referring and relying on the experts to help you improve your scores. So if you pull your credit early on to get your game plan going, you're able to give them very specific steps on what they can be doing to improve it versus just a guessing game.
Absolutely. Yeah. Be prepared, my friends. Be prepared. Okay. Moving right along. I see this one all the time. And, you know, again, if I go back to my intro, the three credit bureaus are marketing companies, right?
Dun, dun, dun.
Yes. And I'm going to pick on one of their things, one of their programs called Experian. Boost your scores 8 points today. And here's what they do. They add non-traditional accounts, your utilities, your insurance, onto your normal credit report. Okay. Now, this situation can boost your scores in very rare situations. And here's where. It boosts when you're that 18-year-old kid and you only have one credit card. Your scores are very volatile and your scores are very limited because of your limited credit history. So in that unique and specific situation, that boost can actually boost your scores. But for somebody that has 25 accounts, lates, collections, and everything else, and you have the boost, you have your utilities on there, it is doing nothing. It is absolutely doing nothing, and I hope you are not paying a fee for that service. So if you're listening to me and you have Boost or something comparable to it, unless you have one account, one true account, or two accounts, you do not need that. Remove it. Don't give them any more of your money. Yeah. Okay. How do you check scores? So there is a law that every year it is free, and you can go to annualcreditreport.com. You can pull your own credit. There is no hard inquiry. It's a soft inquiry. And you can see your trade lines and your credit history once a year. Annualcreditreport.com. You can do that for all three credit bureaus. Now, that report does not pull a credit score or a FICO score unless you pay for that.
Oh.
And so it is one of those, it is possible. It's a modest fee. If you want to see your potential score, then you are stuck paying some money. Number two, lenders. If you're going to apply for a loan with myself for a mortgage, I will gladly provide you a copy of that credit report. Number one is your credit. I go over it with you. I don't provide you just the scores. We talk about it more commonly than not. We always have action plans, and I provide free advice of how do we get your scores better. So providing a copy from a lender is another option. Credit cards. It is very common now for credit cards, and I do have one that monitors my credit. It's only one credit bureau. It is a different scoring model. However, here's what I see. If I have a 780 credit score on my credit card, free monitoring, and I go to pull my actual credit report for FICO for a mortgage, and it's 760, I'm still in the top tier. Now, what I'm looking for each month, and I do track this on my credit card, is what's the pattern? What's the trend? Do I see some information? Did it go down to a 660? If something went down, or I see a movement that's not anticipated by a large purchase or something of that sort, absolutely, this is a good way to look into my credit for potential fraud and also to keep me aware of where my credit is. So you got a credit card. You don't need this on every one of your credit cards. Just sign up for one, monitor it. It's a good, easy, free way for you to keep track of your credit. Although, again, it's not a precise credit score algorithm for a FICO and what I'm going to pull, it is a good way to see very similar of, where it's at. And it's kind of been interesting between you and I think when we've applied for mortgages, my FICO score has been higher than my credit card score, and yours has been lower. And so again, why is there variances? It goes into the algorithm. And so with the criteria that I provided earlier, the length of credit, the amount owed, the payment history, you and I share a lot of the same credit, but we don't have exactly the same credit. And so some of those areas must have been different enough for the FICO to score it differently.
Right.
So, and I will say one of the newer things with the FICO score and the mortgage lending is a thing called trended data. And trended data now looks at not only, again, this is how crazy lenders are in the world of risk. We're not just looking at, okay, your Chase credit card has a $5,000 balance and your minimum payment is $200. They trend the data, meaning we ask the credit bureaus to provide us 12 months of history of what was your minimum payment and balance versus your actual payment. So we want to see if you're a minimum payer, or if you are truly one of those that you have a balance that you do pay in full each month, or somewhere in between and everywhere in between. So it's called trended data. And again, they being the lenders and Fannie Mae, Freddie Mac, all the agencies, having the trended data is a little bit more insight into looking at the risk of, are you a minimum payer, and the likelihood of you defaulting on our loan. Yeah.
Interesting.
Credit monitoring. This is also something that can be done with the credit bureaus. It costs money. I don't think it's worth it because there's free alternatives, like I said, through your credit cards and stuff. Okay. All right. I get this one all the time as well. Credit freeze, where you can you've had somebody that's stolen your credit, there was some fraud, and then you discover that you can actually freeze your credit. You can do this with all three bureaus. It does not cost you anything. You have to manually freeze it and manually unfreeze it. So if you tell me, hey, I want to get pre-approved, Greg, go ahead and pull my credit. If I go to pull your credit and it is frozen, nothing happens. I get a big old error on there. It says credit is frozen. You then have to contact the bureaus individually, and you can unfreeze or thaw out your credit for a specified time period. That's providing you maximum protection. I'm going to think that's up to you, whether you want to have to deal with that. And is that a hassle? Is that not a hassle? How frequently do you have to do your credit? I do have some clients that use that. To me, it's not a big deal other than notifying me that we need to unfreeze your credit to be able to pull it. Now, there's also fraud alert. And, what's the difference with a fraud alert? This is something where you've had some suspicious activity on your accounts, maybe some fraud, and you just want to provide a note. And you want to say, don't open up an account without calling to confirm me first. And you leave your phone number on there. Our underwriters will call you. We will absolutely call. You've applied for new credit. You're saying you want to make sure that it's you. We'll call the number that's on there. You have to say, yes, it is me, and yes, I want to proceed forward. for us to proceed forward. That's not me calling you. That is our actual underwriters that do that.
I had no idea you could do that.
It's pretty rare, but yes,
Like
I
you
do
just
see
do
it.
that through the bureaus themselves as well, or
Yes, yep, through the bureaus. If you want to do a fraud alert, you can specify, you can make comments in there. I was a victim. I normally see a little paragraph in there. I was a victim of fraud, and maybe it's like, I don't want to, don't open up any credit cards without calling me. Maybe you're okay with mortgages. Whatever note you want to leave in there, there is a note on your credit that we read. Yeah. Okay, trigger leads. This is the big one, and I'm going to kind of circle back. We did discuss early on about hard versus soft credit, and when a hard inquiry is made, you have applied for a mortgage with your favorite lender, Greg Abrams at American Pacific, right?
who else?
Exactly. And I'm a mortgage company. The minute your credit report is pulled, these 3 credit bureaus / marketing companies will sell that lead as a mortgage lead. In competitive industries, there's vultures that this is how they operate. They sit by, they buy leads, they spend a lot of money. You're welcome to do that. That is not my mentality or how I want to originate business, but that is a practice that is legal at this point, and they do it. And it's called a trigger lead. When you pull your credit, when you pull that trigger to have a hard inquiry for a mortgage, they will sell it to other mortgage companies. I've heard my clients complain about this.
Yeah.
I have no control over this. I heard one client said he had 18 phone calls.
Nor are we selling.
That is correct. Your information, we have privacy policies. We do not share, solicit, sell your information. It is from the credit bureaus. So I don't like the trigger leads. I think they're terrible. I hate that we have to actually opt out versus opt in. I feel in tougher times, as now, the industry is a little bit more tough, we're seeing a lot more of the trigger leads. We're seeing these phone calls a lot more aggressive. And quite frankly, it's annoying and kind of abusive to the end consumer that they're going to call you. Now, what can you do about it? And we've got a couple different things, and this is what I highly encourage you to. Opt out. You have to manually opt out. It's called optoutprescreen.com. All of these links we're going to put in the podcast notes so you can reference the links and go search these out. But what is opting out? You can opt out, optoutprescreen.com. Let's say you have a Chase credit card. I kept picking on Chase. I don't know why. I do have a Chase credit card, okay? So I'm talking about myself here. With that, Chase owns a lot of affiliates, subsidiaries, and they can also share that information with any of their affiliates unless you opt out. And this also goes with the whole trigger leads. So you do want to opt out. Can't say that enough. Go to that website, opt out, take that off. They will not, some of your mailers that are pre-approved, you'll see less and less and get to the point that you probably won't even receive any of that.
But you need to do that before you go and pull credit with your lender, because then it's too late.
Yeah. As soon as you hear this podcast, you need to go sign up immediately before you forget, before it's too late. Optoutprescreen.com. Number 2, you're going to sign up for the Do Not Call registry. This is something everybody should do it. You can sign up your cell phones. You do not want to be hounded by anybody, any solicitation on your phone. So a combination of saying, hey, I don't want to be solicited or marketed by the opt-out. And then number 2, if you sign up for the Do Not Call registry, this is a federal registry. You can do either temporary or permanent. DoNotCall.gov, they cannot call you. So between the two, you're going to nip most of that in the bud. And I've got a third one, which is the direct mail. This is, again, the mail solicitations. It's DMA, direct mail, something, dmachoice.org. Sign up for all three. These are safe websites. It is true. It will reduce and eliminate you from these solicitors of hounding you. So I highly encourage it. We're going to have the links. Now, I have some positive news. I was not aware of this until I did my research for this podcast, that there is a congressman that has proposed a bill, 2656, that is presently going around, which makes trigger leads illegal. It is doing it where it should, that you don't have to opt out, you have to opt in. And that's the way it should be, folks. So on the NAM website, which is the National Association of Mortgage Bankers, I will also have a link to this. Here's how cool it was. I went to
so easy.
I went to their website, the NAM. They discuss the bill. They talk about it. They say, share the information. They also said, write your congressman. All I did was on the website, I inputted my address. From there, it popped up 3 different parties. From my address, it has Senator Dianne Feinstein, Rep. Salud Garbahal, and Senator Alex Padilla. And with a click of one button, it sent 3 emails to all 3 of these parties. I could have emailed them, or I could have printed the letters, signed it, and mailed it in. It was a few clicks, literally one click to send.
60 seconds.
I've already got an email back from one of them confirming receipt. And this was yesterday that I did that. So I'm excited about this. Please take action. Sign the bill 2656 on the NAM website. We're going to, again, provide the link. And, that's the way it should be with credit. So here's the takeaways, folks. I'm sure many of you have balances that you could probably pay down, pay off, and I highly encourage you to. Don't live off of credit. The freedom that you have when you pay by cash, financing a vehicle, yeah, they're expensive and you can't always pay cash for that. But a lot of times think through the purchases that you're going to make. How bad do you need it? How bad do you want it? If you have to charge it, I understand that there's times. Try not to get carried away in credit. Don't get carried away in the holidays. It's going to really help you in the long term. It's going to provide you with better credit scores, right? Better credit scores will mean lower interest rates. So when you go to finance your home, you will be rewarded by having proven yourself over time with good credit. Number 2, with good credit, you can do anything and get the best rates. You can take advantage of these specials of 18 months, same as cash, so you are highly rewarded with good credit. You are, we're going to say, penalized. You pay for the risk that you are with less than desirable credit. Number 2, slow and steady wins the race with credit. Don't close accounts too fast. Number 3, it seems like a no-brainer. I already kind of emphasized this, but don't co-sign unless you absolutely have to. I understand there are cases that you have to, but just be aware. If you are co-signing it, treat it as if it's your own debt. Be prepared if they cannot make the payment that you are able to. Be prepared to have tough conversations with a friend or a family member that you're keeping track of that and how is their payment history. It is your credit. It takes years to build it and days to ruin it, right?
Yeah.
And so we want to make sure that, again, when it's time for you to improve yourself and purchase a home, purchase the next home, purchase a commercial property, whatever you're trying to purchase, that you're prepared. So that's what I got.
I would say number 4.
Okay.
If I can.
Bring it.
Rely on the experts.
Yes, rely upon the experts. I'm here to help. I'm not here to judge you. I've seen it all. I've seen, 300 scores, 400 scores, 500 scores frequently. I'm never here to say, shame on you. I'm here to say, do you want help? Do you want my advice? Here's a game plan to improve this. Again, when you get into something like that, it's not always overnight that we can fix you 100 points, but I'm pretty sure if you come to me with no matter what credit score you have, I can put together a plan to get you to the 620 level needed for you to purchase a home.
That's exciting.
That is exciting. Home ownership, car ownership, whatever you're wanting to do with your credit is achievable, folks.
Yeah, and we kind of touched on my credit earlier on, early in my credit career, if you will. And I remember, the first time we were pulling my credit, I was all sweaty and nervous, and I honestly felt embarrassed too. I wasn't sure what was going to be pulled, and I loved you, I trusted you, and I still felt that way, like what's going to be there. And it wasn't great, right? And but over time, you educated me, you helped me learn, we improved, and now depending on when I look at my stuff, I'm teetering in the high 7s and low 8s now.
Yeah.
So it's
True
just,
story.
It's truly overcome the fear of looking at your credit and trusting someone who has your best interest in mind to help you get that game plan in place and to work the plan. That's what you have to do that.
Yeah. Well, with that, thank you so much, Sarah. Thank you for joining me today. This has been exciting. Our first podcast together.
I know. Usually I get you all set up and then you quietly close the door and go back to my desk and work. And so it's kind of fun to be on the inner being of the podcast. So
the ends. All right. This one's for you. Hey, Marty, you said I needed to close. Let's close this out right. Thank you all for listening. I appreciate you listening. I appreciate your confidence in me, in trusting me, in guiding you in the right way, especially today about credit. Thank you for everything. This is G Money, Real Talk, everything mortgages and real estate, and we're out. Stay tuned for the next one. Take care.